Welcome to our market update for December 2024, the last one of the year. So in terms of our key investment themes and exposures for the year ahead, we think that there's a lot of macro issues that investors are going to be facing going forward, including escalating tariffs in the US, geopolitical tension, as well as a range of different investment trends, which is going to impact sectors like technology. In terms of economic data points that we're following and thinking about, of course, inflation and interest rates, the headline items there. We do expect to see interest rate cuts coming through in various parts of the world. So we'll talk a little bit more about that in detail. And inflation is expected to continue to creep down, but we think it's going to settle at a higher level than it has in the last decade or so for a range of reasons. In terms of fixed income, we still see that as a very favourable sector to invest in, given the high base level of cash rates, and we're able to generate high single-digit returns in a lot of our fixed income funds. Within international equities, we still think that's a great place for investors to allocate capital to for the long term, for the quality and growth characteristics within that part of the market. Generally speaking, Australian equities look expensive to us and quite cyclical and don't have a huge amount of earnings growth potential there. So we do have a bit of an underweight in that asset class. And the other asset class that we have talked about recently is within small caps, because relative to large cap peers, they do look quite attractive on valuations, and they also offer a bit more earnings growth potential than some of their large cap peers. So if we just think about the performance for equity markets over the last 12 months or so, you can see on the chart here that the US S&P 500 index is up 35% or so, which is absolutely astounding. And nearly half of that that growth has come from earnings. So that's a relatively healthy thing, but half has actually come from valuation expansion. So that's something that we're acutely mindful of. Within the Australian market, the ASX 300, it also has delivered very good gains for investors this last 12 months, up over 20%. But in stark contrast to the US, earnings here in Australia haven't actually grown in aggregate over the last 12 months or so. So that's something that we are a little bit concerned about. Thinking about broad portfolio returns over the next 12 months or so is something that we do every year just to kind of set our expectations. What I've got on the slide here just shows the different expected returns for the various risk profiles that we have, ranging from conservative through to high growth. Generally speaking, the return expectations for the next 12 months are quite similar to what we were expecting at the same time last year. Conservative returns are a little bit higher. That's because the cash rates are a little bit higher. And on the flip side, the highest growth portfolios that we think about actually have slightly lower slightly lower expected returns over the next year, and that's because valuation multiples within the equity market are more expensive today than they were 12 months ago. So just digging into some of the macro issues that we're thinking about over the next 12 months or so. So really there are a range of good things that investors should be thinking about and happy with. The first of which is the capital investment trends in the artificial intelligence areas, the onshoring that's going on, particularly in the US, but also in other parts of the world, as well as the various energy transition investments that are going on, which is benefiting a lot of different companies and industries. Productivity growth is something that we've actually noticed quite a pickup in, particularly in the US, not so much here in Australia. So that's certainly good from a broad economic growth perspective over in the US. Recently, we've had the presidential election in the US. President Trump-elect is coming in. He's going to be delivering a range of initiatives which will stimulate the economy, including tax cuts and deregulation. As I mentioned before, interest rate cuts are coming through in the US and Europe, so that's certainly helpful for equity markets. And the final one is China stimulus. So that is coming through, but to date, we haven't been overly excited by the stimulus measures that have been announced, and neither is the share market for what it's worth. So, and the other thing is China does have some challenges, particularly around demographics. They've got aging population, and they don't have a young population coming through. So that's going to challenge their growth on a sort of multi-decade view. There are a range of challenges as well, and there always are, but that ranges from slowing economic growth broadly, tariffs and trade conflicts, which have yet to really play out. So that's something that markets are going to be very focused on next year. Immigration restrictions, particularly in the US. Inflation here in Australia hasn't been coming down as quickly as other parts of the world. Part of that is that we haven't raised our interest rates as high as other countries. So that's something that's going to keep interest rates a little higher for a little longer here in Australia. And as I talked about previously, rate cuts may not come through as deeply as historically has been experienced. So we just have to see how that all plays out. Just very quickly, just a graphic just to kind of illustrate the interest rate cycle. And you can see that different countries are in different phases of their interest rate cutting cycle. So we've had a lot of interest rate cuts in places like China, in sort of emerging market countries, whereas developed markets like the US and the UK and Europe have only just started to reduce their interest rates. And places like Australia, we're still on the upswing, so we haven't even started to cut rates yet. So different countries at different phases of the cycle. Now, just quickly, I've showed this chart in previous updates, but the trend remains the same, which is that the US share market continues to grind higher, which is supported by stronger earnings growth, particularly within those structural growth sectors, being technology, communications, and consumer discretionary in particular. Valuations are not cheap. There's no way to get around that. However, the growth in earnings does continue to draw us to that market. When earnings growth slows, that's when we're going to be thinking about pulling back from there. But for the moment in time, and also the long term, because the quality characteristics of the US market, we remain very firmly committed to that market. And just in terms of the earnings growth from the various sectors, I think it's helpful to illustrate why we like this market when we kind of go to the next layer down. So as I said, structural growth sectors are the notable outperformers and the notable winners. So earnings growth in these sectors are well over 10%. So communications companies like Alphabet or Google growing at more than 15% per annum, technology companies growing at over 20% per annum, consumer discretionary, which includes companies like Amazon, growing at 12% in aggregate, but some of those big ones are growing at over 20% per annum. And even healthcare is chipping in with 20%, and that's been an underperforming sector, and that's one that we like long term. But there has been a lot of noise recently with the appointment of Kennedy into the government over there. So markets have been a little sour on that sector, but when we look at the fundamentals and the earnings growth within that sector in particular, we still think it's a good place to invest long term. And then just a reminder on Australian equities. So the earnings growth for the Aussie market has deteriorated over the last 12 months or so. And despite that, the share market here in Australia has moved higher. So valuations have gotten more expensive here. The Aussie market has historically been a place where we like to allocate capital for income because of the franking system and the high dividend payout ratios that companies in Australia have. And that remains true today. I guess our point is that you can get similar yields in defensive fixed income investments without taking the equity risk. So that's the first point. And the second point is that a lot of these companies that are paying high yields aren't actually growing their earnings. So a lot of the banks are expected to have flat or very, very low positive earnings growth over the next 3 years or so, given that we are at the kind of top of the cycle for earnings. Our expectations are that bad debts are going to creep up over the next few years as the economy slows, and that'll force interest rate cuts to come through eventually. So yeah, look, there's a few reasons why we're not super excited about the Aussie share market broadly. So look, wrapping it all together, these are our high conviction views that haven't really changed in the last quarter or so. So our views are that economic growth is going to slow, inflation will cool, and rates will come down, but they will settle at a higher baseline than in the past. So we're not expecting to see massive stimulus from interest rate cuts this time round. Fixed income, as we've said before, remains a really attractive source of high income and being relatively defensive in portfolios to provide some ballast. Equities, we definitely have a preference for international structural growth leaders within the defensive equity part of the market. We like that to shore up portfolios so that they're not going to go down as much if the equity market does go down. And then yield stocks for that reliable source of income. Commodities, we haven't really talked about in today's video, but there are a number of different commodities that are benefiting from some of those structural trends like copper, for example, and small caps. We do have an allocation in our portfolios to small caps given those attractive valuations and growth prospects in that part of the market. So look, thank you for your interest. Thanks for watching the video. We look forward to catching up with you in the new year. And as always, reach out to your advisor or check out our website for any more information.